Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money. Today's episode is a quarterly update for Q2 2018. Greg Peterson, portfolio manager of Mawer's Balanced Strategies, provides perspective on global trade wars, rising corporate debt levels, and the influence of central banks on markets. Thanks for listening.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
I'm sitting with Greg Peterson, portfolio manager of our Balanced Strategies. So welcome, Greg. We wanted to talk about the quarter that is past, so second quarter of 2018. Maybe I can just give listeners a perspective. So generally speaking, in equities were up broadly, save emerging markets that struggled. By our benchmarks, I guess our funds follow the Canadian equities were strongest, U.S. equities were next, and then global small cap bonds were kind of mixed. Let's just start there and kind of talk about maybe some of the major drivers of markets in the quarter, and then we'll take listeners on a bit of a ride through the looking forward. So thanks for being here, Greg, and start us off with what happened in the quarter.
Thanks, Cam. Yeah, it was an interesting quarter. There's certainly lots of headlines and lots of concern or talk of concern in the press, whether it's regarding trade or geopolitical concerns in the Middle East and so forth, and yet markets still behaved relatively well. Performance over the quarter was still quite good, generally speaking, and so yeah, all those fears and headlines don't necessarily translate into bad things in investments.
Well, I think one of the major surprises maybe for people would be, Canadian equities did quite well, over almost 7% by the TSX composite. Yet there were lots of, call it negative headlines around NAFTA. So how do we explain that in the quarter?
Yeah, Canada did perform quite well. So it was the best of the developed countries as far as stock markets went in the second quarter of this year. I think some of the headlines regarding NAFTA were probably less negative than they'd been for some while, or just taking a back seat to some degree. There hasn't been a great deal of progress, so I don't think there's been much for markets to really work from as it relates to trade talks and NAFTA. There's also maybe a bit of a wait and see from markets too with respect to whether it's NAFTA negotiations or talk about tariffs in general, to see what actually takes place and what actually sticks. So markets don't want to overreact in either direction for now until they have a better understanding of what's taking place. So that's probably helped Canada a little bit, just as investors back off this concern or this fear somewhat. Generally speaking, other than that, things look relatively good for Canada for the most part. Stock valuations here are, sort of better than they are in other countries. So I wouldn't say that they're fair or inexpensive, but probably on a relative basis, they stack up somewhat better. And that's probably because they've been held back because of NAFTA concerns and trade concerns for some time. Interest rates here are still relatively low, despite the fact that they're generally starting to move higher. The pace is probably a bit more subdued, certainly than we would see in the United States coming up. And earnings here are still very good. We still have our major trading partner is the United States. Their economy is in very good shape and much stronger, and so that should drag the Canadian economy higher or better going forward as well, depending on what happens with trade discussions.
So what I'm hearing, Greg, is maybe a bit of a shift in sentiment amongst Canadian investors, maybe international investors, flows coming in to drive up actually both Canadian equities and the Canadian dollar. So Canadian dollar actually did quite well relative to most major currencies, save the U.S. dollar. So U.S. dollar, I think, was the strongest. Maybe we can talk a little bit about currency impacts and some of the drivers behind that in the quarter.
Sure. So yeah, the U.S. dollar was stronger in the quarter, and the U.S. dollar is stronger against most currencies globally, including the Canadian dollar. So the U.S. dollar added 2% roughly to the quarter to the U.S. equities from a Canadian investor perspective. The Canadian dollar was up against other currencies. We're looking at that the other direction. The pound and euro, for instance, were lower against the Canadian dollar. So if you're holding investments in those currencies or in those areas, then your investment went down with no other change in investment prices and so forth. So that was a negative as it was related to international equities for the quarter, as well as global bonds suffered the same performance.
Great. Okay, so we've kind of rounded out the currency picture. Again, the Canadian dollar did quite well. But what would have been one of the major catalysts, Greg, in driving Canadian dollar performance outside of what you've mentioned in terms of earnings and economy and interest rates?
Yeah, there's a couple things that would have contributed to Canadian dollar strength to other major currencies. And part is actually performance in those other countries. So some of this has been political uncertainty in Europe with respect to the German government, Italian government and their direction going forward, Brexit negotiations and some discourse in Theresa May's government in the UK. Those have contributed towards weaker currencies on that side. And Canada's relative political stability has likely helped somewhat as well. In addition to that, oil prices have been more favorable to Canada. And as much as the link between the Canadian dollar and oil is not as strong as it's been in the past, and that would still likely provide some support to the Canadian dollar as well in the past while, and also is support to the Canadian stock market from oil prices and the lift in oil prices.
So from a sector point of view, oil and energy would have led both large cap and small cap equities.
Yeah, energy was the strongest performing sector in Canada in the second quarter, so it was up roughly 16% for the quarter, supported by not just better oil prices globally, but also the reduction in the discount for Canadian oil. So Canadian oil has always suffered, or not always suffered, but has suffered from a discount relative to West Texas Intermediate in the United States, or WTI, which is the commonly quoted oil price. Here we tend to get a discount because we really only have one market. So Canadian oil flows to the U.S., and we have limited ability to get oil there. And as much as that is limited by either rail or pipeline capacity, we tend to get a discount on our oil here. And that discount improved towards the end of the second quarter.
So would the discount have narrowed partly off of what's been happening in politics and the federal government supporting pipelines?
Yeah, some support there, some movement on pipeline capacity or future look on pipeline capacity, as well as some decisions by Enbridge to open up some capacity on one of their pipelines as well. So there's a change in policy from Enbridge that actually helped fairly quickly to reduce that gap.
So let's shift gears a little bit. We've given, I guess, listeners a sense of segments of the market that went well, but for us at Mawer, we're mostly a balanced manager. So, and you're the balanced portfolio manager. That's why we have you here. So let's talk a little bit about overall, how did the quarter come together for our balanced fund?
Yeah, it was a good quarter for the balanced fund. So it was up fairly well for the quarter, largely driven by Canadian and U.S. equities. Those are the two strongest performing areas for us. We do suffer a little in that we have a lower weight in Canada than we might otherwise. So that weight has been increasing over the past year or so. Still concerned a little bit about where trade negotiations go. So we would otherwise be adding to Canada currently, but we don't want to get too far ahead of what we see from the trade side with NAFTA.
And for listeners, what are approximate weights, Canadian, U.S.? On a total balanced portfolio basis? The
weights are just about equal. So if you look at Canadian large and small cap combined within the balanced fund, we're roughly 17.5% in Canadian equity, and that's looking at the total fund. And we have just a slightly higher weight in the U.S. at about 18.5% there.
And your bias there, Greg, is what, to let markets kind of maybe even those out, or are we thinking of adding to Canada and reducing U.S.?
We're thinking of that, but currently our bias is to maintain the U.S. weight for a couple of reasons. One is the U.S. is a much stronger market, much more diverse market than we have here in Canada. And the other part of it is the currency exposure as well. If we do go through a period of where markets are declining and a bit more of the fear gets into the market, the U.S. dollar tends to hold up quite well. So it's a mitigator to the performance of the balanced fund if things are going down. So we quite like that exposure. We would otherwise, as I was saying, add to Canada somewhat. So our bias down the road would be to add to Canada as some of these trade concerns start to dissipate. Okay,
so that's a good segue into talking about trade. Kind of takes me back to my elementary school ground days, and you get, 1, 2, 3, 4, I declare, I can't even remember what it was, but I declare a trade war. How is the market taking that, and what's our view from a long-term investor perspective? What what does this mean for markets?
That's a good question, Cam. For now, the trade talk is largely positioning, I think, although we've gotten past that where tariffs have actually taken place now at the end of the second quarter. And so markets have been a bit slow to react, just trying to see what actually will hold and what this is going to look like going forward. Do they add tariffs to more products and more goods down the road? Or is this largely positioning, each country sort of playing their cards at the moment, and eventually they negotiate something that's more favorable to one or the other, or perhaps ideally to both. So I think the markets are waiting to see what actually takes place there too. Also, from our research team in talking to companies, company management and businesses are also looking to wait and see how things take hold. They can't allocate capital, make changes to plants and equipment and so forth until they actually know what the rules are going to look like going forward. So there's a bit of a wait and see on that front as well. So far, largely wait and see what's going to take place. And at the same time, understanding the exposures that we have. So what would higher tariffs look like within our portfolios, or what impact would that have on our portfolios? And so that's one of the things we need to be cognizant of. There has not been much trading around that at the moment because we don't feel that there's many places where there's a significant risk. One example of a recent trade where there was some of the consideration was just a reduction in Intertek. Intertek is a quality and testing and certification company that operates globally, and their revenues in part are tied to the level of global trade. And so with concerns about global trade reducing because of higher tariffs, then that has a slight negative impact for them as well. There's other reasons as well, but that was one of the considerations with that change. So, that would be one of the few changes that have directly been made. And then the other sort of direct consideration, I think, is just from the asset mix perspective that we would likely have a higher Canadian weight if we weren't concerned about this as well. So that's probably the other area that's impacted our decision making.
Okay, good. That was a good description with a little company example there. I'm a cheese lover. The one I think of is Saputo. So if Saputo's in the U.S. and Canada, they'd be in the crosshairs of tariffs, but I think they'd have flexibility in terms of their business model to make changes and move on.
Yeah, Saputo's a good example because of the talk around dairy and Canada's supply management system on the dairy side, and just how that's been targeted by President Trump. So Saputo being the largest cheese manufacturer here and dairy processor naturally fits in with that as well. I think Saputo's in a good position, though, where they have production on both sides of the border, and so they're an example of a company that can be relatively nimble and adjust their production depending on what rules are actually put in place. So they can adjust both production and then supply as well in terms of where they're sourcing wholesale milk. And so things will adapt, companies will adapt as they go forward, depending on how the new rules are written.
So what I'm hearing is not a lot of direct, I suppose what I'd phrase as speculative kind of positioning by our teams around trade wars. I want to transition to kind of the next topic, and that's what we're observing is rising debt levels in corporations. So both, I think, the Bank of England and the Fed chair, both in their latest press releases, their latest public commentary, were mentioning corporate debt as a concern. How do we feel about that? What are we looking at?
Yeah, rising corporate debt is fairly typical as you get later in a cycle. So there tends to be more merger and acquisition activity as you move on through a cycle, and a lot of that can be financed by debt, and so that's a natural increase in corporate balance sheet debt from that taking place. The other is just the fact that we're coming from a very low interest rate period where businesses are taking advantage of issuing debt at very low rates to raise funds, whether that's for acquisitions and reinvestment, or as in the case in the United States, there's been a lot of buybacks as well. So share buybacks, companies retiring some of the equity side of their balance sheet and taking on more leverage as they do that. So the higher leverage for a business can be somewhat concerning. So it's one of the things that we look at as part of our criteria in evaluating companies is their debt levels, their ability to service that debt. Naturally, the concern for higher debt levels is that as the more debt companies take on, it does increase their risk during an economic downturn. So if revenues start to shrink, it's very much like a consumer borrowing heavily to make purchases or perhaps to fund a house purchase. If their income should decline, it's much more difficult to service that debt. And so it's the same case for businesses where too much debt, shrinking revenues, it's more difficult to make those payments. And certainly their returns are going to decline in that environment as well. So they're no longer growing earnings because of the debt, ability to cover that debt. The second part of that, too, is the fact that interest rates are rising. And so higher debt in a rising interest rate environment also becomes more expensive. So our concern there too is that we'll press on earnings as they go forward. Earnings are a very large part of stock returns, and so if earnings are declining, then stock returns are likely to suffer as well. So this is a case where we tend to review our portfolios for businesses that are highly leveraged or have higher leverage, and start to make some adjustments at a corporate level from there as well.
Okay. Is it safe to say, I'll give you a simple yes-no question, but is it safe to say for more portfolios, equity portfolios, that we rely less on, we don't rely less, we choose businesses that rely less on debt as part of their strategy?
Yeah, that would be fair to say. And there's been some recent examples as well. So LKQ is an auto parts distributor in North America. This is a business that has been growing through acquisition. And we've had some concerns on two fronts with LKQ in the last while. So one is just their aggressiveness on acquisitions and the purchase price that they're making for these. But the second part of that, too, is how much debt they're taking on to fund these acquisitions. So we've had some concerns around management's decision-making and being a bit too aggressive. And so we've been trimming the LKQ back within the U.S. portfolio and reducing our exposure there for those reasons, as well as just the general leverage and environment.
Thanks, Greg. We covered a bit on the trade war and what the risks there might or might not be. We've covered some corporate debt, and within that discussion of corporate debt, you mentioned rising rates. So naturally, we should talk about what are central banks doing in the marketplace now? What are some of maybe the indicators we're looking at to gauge that? And maybe evaluate what the willingness of these central banks to step in and support markets like they have for the last decade, where they're at on that.
Sure. So central banks in the developed world are largely increasing interest rates. So they've been very accommodative ever since 2009. So that's when interest rates were exceptionally low. They've stayed low for a long period of time. And then the concern becomes that there's excesses built up in the market somewhere, which is quite often asset bubbles or some sort of bubble. So eventually, as economies improve and the need for that stimulus is no longer there, as we are now, central banks will start to remove that stimulus, and they have been for a while now, especially the Federal Reserve in the U.S. And so the Fed is likely to continue raising interest rates. We've had 2 rate increases this year. It's expected that we have 2 more to come through the rest of the year, likely followed by a few in 2019. Canada is also at the point of raising interest rates, although more slowly than the U.S. Currently. And so we do expect that interest rates will continue to increase. So economic growth has been solid. That was one of the reasons for low interest rates to begin with. Inflation was exceptionally low, and there was a fear of deflation. Deflation is much more difficult to battle than inflation is. And so interest rates were kept low for that reason as well. So we now are back in an environment where economic growth is good and inflation is relatively firm in the developed world, and there's no longer a need or the same need to have stimulus. So central banks are not just raising interest rates, but also reducing their bond purchase programs. So they're not printing money that they were during the way they were during the crisis as well. And the European Central Bank is likely to wrap that up by the end of this year, barring any unforeseen circumstances that may come up through the course of the year.
So what might that mean for asset prices? So for listeners, bring it back to their portfolio and what does that all mean?
Rising interest rates are typically a headwind for stock markets for a couple of reasons. One, higher interest rates. We talked about higher costs on debt for companies that will pressure earnings somewhat. Presumably, when you have solid growth and earnings are growing, then that higher cost of debt is offset somewhat by the growth. So that's not a bad thing, depending on how well that relationship holds. The other is that interest rates are a big part of what's called discount rate for evaluating stock prices. So higher interest rates, all else being equal, would mean lower stock prices looking forward. So that is a bit of a headwind for stock prices there.
So it looks like the path of interest rates obviously is going up. I think one of the statistics out there in the quarter was a Bloomberg indicator of central banks says that Turkey's the only one that looks like they're going to lower interest rates in the next year. So we've got a good perspective in terms of, okay, the market looks like they're expecting higher rates over time. The risk in that maybe, Greg, is that a central bank over-tightens. So they raise rates too quickly. It leads to recession. What kind of indicator can we look at in the quarter that might tell us where we're at in terms of over-tightening, under-tightening?
Yeah, that is definitely a key policy risk that central banks would over-tighten, and that's likely due to a fear of inflation. So we saw that perk up back in January of this year, where inflation concerns came up, and markets responded fairly quickly, which caused markets to go down because they expected higher interest rates because of that. And then that fear has since faded away a little bit. That risk is still there, that central banks over-tighten. One of the key things to watch is just the shape of the yield curve. And so what I mean by that is if you compare short-term interest rates, or bond yields rather, such as the 2-year yield on government bonds, compare that to the 10-year government bond, that gives you the difference between longer-term and short-term rates. And as that spread diminishes, that's one of the signs that perhaps tightening is taking place. If you have 2-year bond yields that are the same as 10-year bond yields and you put that on a chart, you're going to see a flat line because they're essentially the same. So that's one of the indicators we watch, is the shape of that chart. Ideally, you have lower short-term interest rates and higher long-term interest rates. That's a good indicator of economic strength to come. It tends to be good for banks. Banks tend to borrow short, lend long. And if they're borrowing short at lower rates, they're able to lend out at higher rates longer term, then the banks are able to maintain their profitability or grow their profitability. So as that relationship tightens, their ability to make money also declines. And so the financial institutions are a big part of the economy. It also affects their willingness to lend. If they're not making money, they're less willing to lend. It's sort of fuel for the economy, if you will, if that credit starts to dry up. So that's one of the indicators we watch, is the relationship between short and long interest rates. That relationship right now is relatively tight historically. And so if that should tighten further, then that's one sign that we're getting closer to the end of this cycle, or perhaps closer to the end of economic growth for this particular cycle.
All right. Is there a particular yield curve difference you look at?
Yeah, one of the most reliable indicators has been an inverted yield curve. So you may see this come up in the press from time to time, or talk about it. An inverted yield curve means that shorter term bond yields are higher than long-term yields, or short-term rates are higher than long-term rates. And so that's a relationship that has historically indicated that a recession is likely to come fairly soon. And so that's one of the things we watch.
At a portfolio level, then, how do we try and incorporate that risk into the portfolio? It's we're bottom-up investors, so we tend not to make bets on which way rates are going to go, but we kind of maybe worry macro and think micro. So bring that back for listeners in terms of how you look at it from a balanced portfolio.
Sure. An inverted yield curve is likely to cause us to make some adjustments to asset mix, to be a bit more cautious on the equity side going forward. That would be one. What's more likely is, as we get to that point, we're more concerned on the security selection. And so we've already talked about watching debt levels for corporations, companies that have a need for capital. We will tend to shy away from businesses that have a high capital cost in an environment like that as well. And so adjustments tend to come from the security selection. And then the other, quite frankly, is just setting expectations for our clients. So we're not going to try and avoid this entirely, because then this would be market timing, and that has its own dangers, if you will, of trying to believe that you'll get that correct. And so it's really setting expectations that returns are likely to be lower, or perhaps we could see some negative performance for a short period of time. Yeah, so we recognize that an inverted yield curve may indicate that a recession is coming, and we'll make some adjustments to the portfolio, perhaps in anticipation of this, but it's not something that we feel investors need to spend much time worrying about. It is just a general ebb and flow of both economies and markets, and so markets always go through various cycles. Economies go through cycles and periods of growth and recession, and so it's not something to be concerned about. It's just something to be aware of, that this may happen, and not to worry so much about it. That's our job, is to worry about these things. And really what it does is it also allows us to reposition the portfolio sometimes, taking advantage of opportunities, and working through the risks as we see that as well. So
we've had a good discussion, Greg. Thanks for walking us through the quarter. Some things to think about in terms of trade wars or currency effects or how we manage things. But I really appreciate you taking time to walk listeners through the quarter, and I'm sure we will have you on in third quarter.
Thanks very much, and have a great summer.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.